welcome everybody. So a couple of quick introductions. So I've got Sam Vakili here. So, no, that's fine. Well, wherever you got to go. If another person comes in, you're getting kicked out, okay? You got to go stand. So Sam's with RBC. So I'm Sam. He's been called worse though. Don't worry. So with RBC, we're all in specialists. Okay, so I do mortgages all day long. Sam's on the other side of the balance sheet. He's the investor guy. Okay, so just like me, we're going to talk about this. Just like me, I'm commission based. I want to get the deal done as bad as you do. Sam's in the same business. He's also commission based. So we're all trying to do the right thing, and we're trying to get the deal closed for you guys to make sure we've got the best options for your client. Okay.
Investment properties?
No.
Non-investment properties, mostly investments in the general sense. Investment properties is where his specialty is, but that's why we sometimes go together.
So
we'll get into that.
he's money in, I'm money out. The best way to look at it. Okay. So we're going to be talking about a couple of programs today where Sam could come in, and I know clients are always worried about rate and fees and stuff. He can save them a lot of money and make them some money, right? So that's where he partners with me to be able to offer those solutions. Okay. So we might call on Sam to talk with you a little bit today. Krista Stacy is also on her way. Okay, so she's commercial banking. All right. So I know I've been getting some questions about commercial properties. I'm 100% residential. I don't do commercial. I don't have the patience for commercial. I just don't do it. Okay. So Krista's coming in today. She's going to talk about commercial properties, what she does, how she can help you if you do have clients that are looking for different types of commercial stuff. Okay. With RBC, we're all in specialists. Okay, so you notice we all work in teams for this stuff, okay? If you need something, another person that's not here today, Sarah Curl, she's just like myself and Sam. We run around with a laptop. She does bank accounts, loans, the whole bit. I'll give an example. I met with a first-time home buyer from Sally last night, and he's not ready yet, but we're going to take his existing debt, reduce the interest by more than half so we can buy a house in 2 years instead of 5. Okay, so that's the kind of stuff we're able to do. We're not just, I'm a one-trick pony, but the RBC group is not. Okay, so just to give you guys a sense. Shameless plug, okay, so if you need to hit me up on all your stuff here, so YouTube and podcasts, if you want to sound really smart with your clients, you can say, hey man, my mortgage guy has a podcast, or you can go to his YouTube channel and hear the first-time homebuyer webinar we did, I think earlier this year, right? So you've got different tools available to you, okay? By all means, pop in there.
Podcast, by the way.
Especially the last one, eh? Did you see that one? That one was really good. It was pretty good. That was good. It was good.
I really enjoyed it the 5 times I watched it.
There you go. See, exactly. So if you notice the views are really high, it's because of her, but it's all good. That's right. So like me, love me, follow me, all that other fun stuff. Okay, so let me start at the very beginning here. So I love when I get, your first-time home buyer, your second buyer, they have a down payment, they have a job, they have good credit. It's always very exciting because I can get it done in half an hour and move on with my life. However, we don't, 80% of the time, those deals aren't there. Okay, it's usually there's something on the deal, especially nowadays with credit being so prevalent and everyone can get credit from everywhere for however much they want. Everyone usually has a little bit of a challenge within the application, okay? So that's what we're talking about today is specialty programs, okay? The whole purpose of today, I don't want you to have to sit with your client and determine whether or not they would be approved for a mortgage, okay? I just want to make sure that we've got different specialty programs to offer clients, okay, in the event they don't fit the traditional financing box, okay? So as long as we have the programs, that's all I really need you to do, because again, I don't want you to say, oh, Stephen, get this done because you're self-employed, you make this amount of money and you have 10% down. Because then they get to me, and then I'm the bad guy, and I'm like, heck no, we can't do this, right? As long as you know there's an option, that's what I want to be able to provide to you, okay? As we go through this, ask questions, okay? Definitely ask as many questions as you want because it's important. If you have had scenarios that you've run into that could or could not have been done, let me know, and we can talk about it.
Back up a second, Stephen.
Yeah.
You had on the last slide the
We're going to get to that. That's if you're buying from a builder with a carry-on warranty that offers carry-on. But we're definitely going to get to that. Okay, investment properties. So investment properties, I spent a lot of my time on this, especially in KW, okay, and many geographical areas around, I say within an hour of here. Very popular for investors in Ontario in general, this area. So a couple of things that, just some specialty items that RBC looks at. So let me talk about student rentals, okay, because I know this is a popular one, especially in Waterloo. And we've just had a lot of clarity brought down as to what we will and won't do, okay? We technically do not finance purpose-built student rentals, okay? Icon 330. We were in on that, now we're out, okay? Lux in London, another purpose-built student rental, okay? A common element in the middle, 5 bedrooms around it, that could never be resold as anything but a student rental, okay? The bank does not like financing properties that only they could assume the debt in the event of a repossession, generally speaking, okay? We will, however, and if your clients or your investors, and if you know how to coach to this, you can help with it, we will do single-family homes or even duplexes that happen to be rented to student tenants. Okay? Let me explain that a little bit more. So if you happen to have 4 or 5 individuals, can't really discriminate if you're a student or not. I mean, what's the difference between a married couple who happens to be going to school part-time to an undergrad, right? Technically, code of whatever, Canada Code of Rights or whatever it is. So as long as they're all on the same lease, so if you've got 4 students in there and they're all on the same lease, and it's a single-family home, you're fine. We're okay with that. If they're all on separate leases, that is a rooming house, which is worse than a student rental. No one will touch that. Okay, rooming houses are usually higher risk, different type of tenants, short term. Nobody likes those. Okay, that's a B lender deal at 10%. Okay, they like those.
What if you're living in a house, like say you have a basement apartment, you're living in a basement, you have to upstairs rent to the students?
Yep, same rules apply. So as long as they're all on the same lease.
So even if they're separate leases and you're living in a house, that's a problem.
If the basement is rented to 3 or 4 individuals and they all have their own lease, that is not allowed. That is a rooming house. Yeah. If you're living either upstairs or downstairs, doesn't matter. As long as the second unit is a legal second unit by bylaw and code and all that other stuff, and they're all in the same lease, you're fine. How do we determine student rental or single-family home relative to the appraisal? Very simple. The appraiser goes in, deems it a student rental rooming house, dead deal. Appraiser goes in, single-family home, highest and best use student rental, we're okay. As long as he deems it a single-family home. How much control do I have over that? None. Okay? Any questions about that? Is that clear? There's a lot of gray, believe me. That is very, very clear, but there's a lot of gray, okay? And I will say, if you are purchasing a single-family home duplex that is currently being used as that and they plan to rent it to students, the best coaching you can do, guys, everyone on the same lease agreement. Everybody. Banks don't, rooming houses, forget it. They won't touch it, okay? That's probably the most complicated part of all this. So 5s and 6s, we are the only bank doing 5-plexes and 6-plexes under residential line of business. Everyone else is commercial. Even if it's residentially zoned, it's commercial. We will only do it if it's residentially zoned, but we do 5s and 6s, okay? I know realtors love them. I love them too because they cash flow like mad, and they're usually relatively easy as long as the client is strong, okay? The single-family homes with student tenants, I need to change that slide. Single-family home with student tenants, 5s and 6s, 20% down. Okay? We're not in 30% down world anymore. It's all 20% down. Okay? Investors love that. We do use market rent. If the property is not currently rented to tenants, we can use 80% of that market rent based on the appraisal. So that helps the application a lot. If it is already rented to tenants, and they are assuming the tenants in the Schedule A, and you provide them with a lease agreement for the same property, don't laugh, it's happened, we will use 100% of the rental income.
How common is that nowadays? It used to be very common for my lenders to do that, but
It's pretty common. It's pretty common, yeah. I'm seeing a very big, I don't want to digress too much, but I'm seeing a very big shift of people buying single-family homes and converting to duplexes because the cost of homes is not kept up to single-family rental incomes. I've seen that shift in the last 8 months. Before that, it was very common, assuming the existing tenants, as long as the tenancy made sense. All right, so holdcos. We are the only ones doing holdcos. So if your client wants to register their property within a holding corporation, we can do it. We have rules. I'm not going to go through every rule with you, but we have rules. 20% down. Okay, titles in the corporation, they still have to provide a personal guarantee. Investors eat it up. Do not, and I don't do it either, do not say, oh, Stephen could do a holdco, go start your corporation. It costs thousands of dollars to start a corp. Not until I say you're good and tell them what it has to look like, do you send them to do that. Okay, that's really, really important. Okay? But we do it, 20% down. Talked about the use of the actual rent. Hey, come on in. Oh, and sorry, I just actually talked about using market rent on existing property if moving into the new home. So.
You don't get a chair, sorry.
No, that's all good. Just so you know, Sam stole your chair. Just want to throw him under the bus a little bit. Okay, number of properties. I'm always asked about this. Okay, I'll start with telling you how many we do, but don't get excited till I finish my sentence. You're going to find out why. We do up to 9 financed properties. Exciting? Not really. Because within that 9, max 5 to 6 investment properties. Everyone gets excited at 9 and then I go. Yeah, so max 5. However, there is a rumor right now that we may be going to 9 finance no matter what. That's not done yet. But I can tell you right now where RBC is probably the most progressive right now is investment properties. Okay, so max 9. So if, for example, if someone has their owner-occupied home, a cottage, and they have a condo for their kid at school, that does not count as investment property. They got to be able to afford it all, but it doesn't count as an investment property. Okay? Any other questions on investment properties? If you have investors and they want to start to get into it, my comment is, because I deal so much with these guys, if they want to get investment properties, have them come see me before they start putting offers in on everything. Okay? If I can plan them out and tell them how they can get up to that 5 and 6 or how it looks like, that'll work for you real well because then you'll know what you need to do with your client. And I go through all the math with them so they know exactly what they need to do. Okay?
Stephen, is there anything RBC offers as far as sort of a blanket mortgage for numerous properties?
Great question. We do have a product within commercial banking. They will authorize a credit limit, and then you can go and play Monopoly within that limit. Okay? It is a tougher qualification. I have no idea how you qualify, but it is a commercial solution. Those are generally for people who are, I've seen those limits go from 3 million to 10, but there's a ton of different qualifications for obvious reasons. It's a great product, but there is that available. So you're welcome. And we do 30-year amortizations. Some banks are only doing 25. We also don't charge, just on the rate side, all banks except us, I don't know if BMO does it, BMO's not a big player, but most of the banks are all charging premiums on investment properties for rate. We are not. We've been the lowest rate on investment properties for at least a year. Everyone else is charging premiums. Okay. Builder. Okay. So Jenny, this will answer your question. So Our builder program is so good, we have builders calling us to do their approvals, okay? You have to understand what has started to happen, and I'll use the, you guys know the Marilyn Monroe building in Mississauga, the one that's all twisty-turny? Okay. So a few years ago, they had a bit of an issue. They went to fund their deals. The main bank doing all the deals were Home Trust. And when Home Trust went to fund, they're like, oh crap, we own 80% of this building. And they were just pulling approvals. Like, nope, we're good. We're not going to fund this deal, okay? So the bank never wants to own the whole building, okay? This is where RBC comes in. So if you're buying from a qualified builder, when I say qualified, generally Tarion warranty is required, okay? No matter your thoughts on Tarion, it is required. We do what we call firm approvals, which you guys all should know about, for builder deals, up to 3 years, okay? So we get builders constantly knocking on our doors, especially for condos, okay? Because they want to know their deal's approved. All of a sudden one day I'll get busy with like 5 or 10 units from one project because we just figured out that the builder, to get their dirt financing, need X number of firm approvals, and we're like the only bank that gives it out. So where this comes in for you is if they want to buy a new build, okay, we give them a firm approval based on their current state, okay? If leading up to funding, they change job 3 times, buy 4 cars, and rack up their debt, we're still funding the deal. We're not pulling a last minute credit check. We're not like, hey, can I see one more pay stub? 2 exceptions to that. They change the property, obviously, okay, because then we don't know what you're buying, okay? And if they have substantial changes to purchase price, because now they need more money. I know myself, I email all my builder clients every 2 months. I need to know closing date change, I need to know change in price. Okay, because if they've all of a sudden added, and I had this happen one time, they bought from, I think, Hawksview, 550 base. I emailed, are you guys okay? Yeah, oh yeah, no, we're good. 2 weeks before closing, I got a $90,000 upgrade bill. And I'm like, guys, I need pay stubs, I need T4s, and I'm re-pulling your bureaus. Okay? So we're all good and firm, but they've got to keep us updated as things go along. I've already said it in investment properties. I asked the question up front, are you guys going to be putting in upgrades? I need to know so I can plan this, right? So as long as I know and we can plan what they're doing, especially on condos that are 3 and sometimes 4 years out. Now the rate's good for 3 years. I've had condos go 5 years and not close. Even on those, no change in purchase price, no change in property, we funded the deal. And some of these clients have like gone and bought 4 more properties, right? So it's important that I understand when I sit with them and I know if they're going to be putting up upgrades and stuff like that, okay? The other thing that we also offer on this, it's very, very important, we offer complimentary life and disability insurance. If they apply for the insurance and they're approved, and it is group insurance, all right, so it's relatively easy to get as long as you don't have any pre-existing conditions, they can get a firm approval from us, take the life insurance, die, and we still fund the mortgage. Why this is important is, generally speaking, in this day and age, if you normally need 2 incomes to afford a house. So if one person dies, I have to requalify just the one individual and hope the hell they approve. Or otherwise you don't close. Can't close a deal with someone who's not alive. So it's they don't pay for the life insurance. How cool would that be if unfortunately someone dies and they're still getting their house? Did it? Oh, did it? Yeah. So we offer that insurance to cover them. Right?
Well, it's worth dying at.
Pardon me?
It's really worth dying.
Depending if like your husband or wife. That's how nice the house is. Any questions on that? Do you guys bring your clients to builder sites? Because I know it depends on what they pay, if they pay. I know there's sometimes that kind of gray area with stuff, right? So. Oh, did you? Yeah, so we have a program for them, right? I will say the rate, I tell people, especially the condos, don't worry about the rate, man. Seriously, the approval is more important. You ask 9 out of 10 people who have been through this, the rate is so inconsequential, just make sure my approval is there, okay? We do a special builder rate, so we'll hold the rate for 2 or 3 years, but the rate is always higher for a builder rate. 90 days before closing, we look at the rates. If that builder rate at 4.25 is lower than the rates at that 90-day point, if it's lower, they're going to be pretty happy. They get a lower rate. If my builder rate is higher than what the rates are 90 days before closing, they're going to be really excited because they're getting a lower rate. It's just a rate to protect them. I know when I tell people, oh, well, your builder rate's 4.25, get me the hell out of here. No. Whoa. Let me explain to you how it works. Okay? Any questions on builder? It's an awesome program, guys. If you do go into a builder site or if you have a builder site, okay, we do financing sheets, the whole bit for the respective builder. Okay? All right, self-employed. Let's talk about these nice people. So I will say, along with the investors, self-employed is probably where RBC has completely loosened the reins on our approvals. Okay, at the last meeting, I used an example. We had individuals drowning in debt, probably made some bad decisions, both self-employed. We were able to take his income based on our policy, shelter payments, etc. We doubled his income based on our formulas. We brought his overall monthly debt obligation, including housing, I think it was like $6,500 to $2,000. We paid out a first at Home Trust at 6%, $200,000 second at Magenta for 12.9, interest only, and a crap load of debt because they did rentals on the house and maybe shouldn't have, okay? So they had good credit, they had equity, we did the deal. They're pretty happy, okay? We do have, so you guys are all, as an example, you guys are all sole proprietors, right? So you guys have on your tax returns, you have your gross income, your net income, okay? Very simple. If we can use your net income after expenses to qualify for the mortgage, you're just like a regular customer from a qualification perspective. Note, we don't do what we call add backs, where we say, oh, let's take the capital cost allowance and add it back into your income. We don't do that. We just add 15% to your net income. Okay? So if we can qualify you on net, perfect. If you're incorporated, I know you guys aren't, but if your clients are, if you're incorporated, we can use a combination of dividend and salaried income. Okay? I wouldn't get that granular with your clients. Just know that that's a good rule to have. Okay? If you have an incredible accountant who saves you a ton of taxes, we have a program for you. Okay? We do have as low as 10% down, what we refer to as stated income. Okay? A really good example of that are all of my pizza owners. Okay? Their gross income is like $400,000 or $500,000, and their net is 10. Happens all the time. Restaurants are all like that if they're not incorporated. So what we would do in that case, I hate to say it this way, we kind of make it up a little bit, where we do add backs. We have to give a justifiable income, and to be honest with you, we make it up to the point where it's like, oh, these numbers work now, and send for approval and let them tell me no. Okay? So as an example, what we would do with our stated income program, we would look at a pizza as an example and say, okay, we're going to add back capital cost allowance, capitalization, a couple of other lines that are really just for taxation purposes, throw it back into the income, and see if we can get it approved at 10% down, or 15 or 20. Okay? So for those people with amazing accountants, we have a program for you, but it's minimum 10% of your own funds, and you can never be bankrupt. Why I know that? Because I had an amazing application, and of course the insurer found out 20 years ago or whatever, he had declared bankruptcy and it was a dead deal. So never, ever, ever can you have ever had bankruptcy in your past. Consumer proposals count as well. So you couldn't have had any legal action against you for debt consolidation. Okay. Stated income. So stated income equity. So the clients I told you about with the shelter payment and how we saved them a whole ton of money, they had 35% down. Okay. If they have 35% down, it is no longer, here's 35% down, no questions asked. That didn't go well at CIBC. I think OSFI, who's the Ontario superintendent for financial institutions, has an office at CIBC right now, okay? So 35% down, we have a little bit more flexibility where I can double income based on our metrics and shelter payment and stuff like that, okay? So if you have a self-employed individual who you know has a lot of equity, just know that RBC has a little more flexibility with them, okay? Does that make sense? Long story short, our self-employed, all of our programs have very good flexibility as needed. But I also do tell clients this, an amazing accountant doesn't always equal getting a mortgage. It is what it is sometimes, okay? And I also tell them this, and I think I rationalize it with this. Look, you can save all this money on your taxes, but you can't have it both ways sometimes, right? So.
So what can, from that, like, do you,
I think that's the next slide. That's a great question. Thanks. Yeah, no problem. Yes, you have to have your taxes done. You would be surprised how often I get that question. Yes, please do your taxes. Oh, and while you're at it, pay your taxes. We will not lend you a cent unless you have paid your taxes, or it's a condition of our deal. Can you close that door for me, please? Thanks, Sam.
seriously run into that, where there's
I just refinanced a deal. Now this is an extreme amount of money, but I had to bring his home line plan from 1.3 million to 2, and I had to pay out. He needed money for his daughter to go to school in the U.S. and save cats or whatever, and as a condition of my deal, I had to pay out $143,000 in 1 year of taxes he didn't pay yet. He knew it, so I mean, he wasn't fighting it, right? Wasn't fighting. He's like, oh yeah, I owe the money, right? So, so when Dan does a course with you guys on how to save money and pay your HST and your taxes, listen. Okay, do it, because you don't want to be in that situation where he's lucky. He has a $4 million home in Toronto. He's a happy camper, whatever, but that doesn't always work out well, okay? Yes, taxes have to be done. We have to know if you are incorporated and you're paying yourself dividend T5, T4. We need to know that that's actually your business. So we will need the articles, okay, just to make sure it actually belongs to you. And sometimes, remember how I said we're really flexible? I may need to see bank statements to try to mitigate my deal. That sometimes happens. I will say RBC is pretty common sense with a lot of stuff, okay? Another gentleman that is not here right now, his name is Rocco. So sometimes I get the question of, well, do you just do deals with RBC? The answer is yes, but if we have someone who's self-employed, hasn't been self-employed very long, Rocco Vasco, who doesn't sound as scary as it sounds. I'm Italian too, so I can appreciate it. Rocco is our alternative mortgage solutions. So he works with Home Trust, Bridgewater, Equitable, et cetera, et cetera. Sometimes, again, the self-employed, I know you're saving lots in taxes, but you may need to pay 5.99 on a 1-year term to get your house. Can't have it both ways. He has even more flexibility. So if they come to me and I can't get it done, I know on the self-employed side, Rocco can look at 6-month statements and get a deal approved. But I need tax returns. Okay? So you, go ahead.
what does the T1 general show, like the notice of assessment? I know you explained.
Yeah, all the details. So notice of assessment will show line 150, all income sources. T1 shows what all the income sources were: self-employed, dividends, salary, RSP income. So sometimes people say, well, my line 150 shows 100,000, but 80,000 of it was an RSP withdrawal. That's not income, right? It is taxation-wise, but not for our purposes. Yeah, I have a lot of that time. Here's my NOA. I'm like, great. Where's the rest, right? So, but is that, I get that all the time, though. It's a great question. Okay. So to your self-employed people, like, oh, I can never get approved. I want to see them. Not making any guarantees, but between me and Rocco, might not be a perfect deal. There's probably something we can get done. Okay. The other part of it too, I will say, and this is where I'll talk about Sam too. I find a lot of businesses have cash and they don't know what they're doing with it. Okay, this is something where Sam could maybe help them out a little bit too. Okay, because I think businesses tend to just throw it somewhere and hope for the best. I've said this 2 or 3 times already. Planning is really important. Okay, if you've got a business owner that you know at some point would like to retire, sell a business, whatever, that's where Sam would be engaged. Sam wants to see those people, yes? So if they have to sell their business later on in life, right? Stuff like that.
A lot of those clients, the reality is the more you can be for them before they actually sell, the better they're going to be when they actually do. Right? A lot of what we're talking about is all this flexibility. The more information we know, the better it's going to be for them. A lot of business owners, they just leave their cash sitting there doing nothing, which is fine. Other ones are thinking, well, 5 years down the road, I might sell. There's usually going to be a massive tax burden and massive cash flow that comes from that. And I'll give you one quick example. So there's something called capital gains protection in Canada. So if you sell your company right now, it's like 800, let's call it 850 grand, somewhere in that range. So if you sell your business and it's a Canadian-controlled corporation and it qualifies, you can shelter up to 850 grand. Great. If you had your spouse on there as part of like the legal documents, now it's 850 times 2. If you had your children over the age of 18 on there, you start to see how it can cascade. So it's $5 million business, which is just sold in one person's name, only shelters 850. If you had all the family in there, you might be able to shelter all of it, right? So it's little things like that that you can do for a client, but the problem is nobody likes to talk about it because finance are private, especially the money that's coming in, not the money coming out. And so sometimes you don't get transparency, you don't know the details, but that's just a quick example of some things we do. Holdcos, we talked about it again. The clients that if you fit the holdco model, you start to get this kind of confidence that comes, okay, well, holdcos are the best thing. I'm just going to have 15 properties in my holdco or 9 or whatever it is. But the problem is eventually you sell those properties and you might be 70 or 80 by the time you start to draw it down, but then it becomes taxable. So if you set up your holdco correctly, again, by putting family members on there, you can disperse the income to those family members or whomever it is when that day comes. So it's not one person drawing down 5 properties worth of, eventually sell those properties. They have to go somewhere. You don't get to just take the money out of that holdco and run to the bank laughing, right? You have to declare that tax. So it's little things like that where,
Yeah, and I'll say this. So everything Sam just said, I don't know what he just said, it makes sense. But this is where your clients, I don't know that stuff. I'm working hard on my specialty, which is mortgages. If you could imagine your client having the power of me, the investment guy that does money in all day, a commercial person, and then Sarah doing bank accounts and loans and saving the money there, it's kind of it's our shtick, all right? This is it, all right? Anyway, that's why I just want to make sure you guys knew that. So, okay, I'm going to keep going here. So I talked about this already. So if you have a standard program, right? So if we can qualify you on net income, we can go 5% down. Savings, we can take gifted down payment. We find that a lot now, right? Millennials don't save money, but they're saving money on their Starbucks card, right? So I was there this morning. I shouldn't really talk. Stated income. Okay, again, I talked a lot about this already. So 10% down, 2 years self-employed. It is a default insured program. Genworth is the default insurer. Default insurance company is the one like CMHC. Okay, max loan 600. Maximum 25-year amortization because it's default insured. Okay, and then I was talking about credit. Okay, so they have to have good credit. 680 is about the breaking point. Anything under 680, and there's usually something wrong on the bureau that we have to identify and deal with. Okay. I'm not going to go through this. It's kind of boring. Equity, we talked about this. So that client I use as an example, we can use in his case, I use 2 times their income. Maximum value AM, TDS, GDS. Okay, so TDS is your affordability on all your debt. GDS is on just your housing expenses. I'm not going to go through all that. We have to do full appraisal on the equity program. Okay, the larger the amount, whenever you hear the word equity program, it means there's additional risk to the bank. Full appraisal. Okay, there is a fee for appraisals. It's $300. The cool thing with RBC, ask any bank, the appraisal is usually like $400. But because RBC does so much volume, we just charge a flat fee, $300. Okay? If the deal doesn't go through, they don't charge the fee. Kind of cool. Investors like that a lot. New to Canada. All right. So we have a bunch of boxes to stick new to Canada people into. It just depends on a lot of factors. Okay? What you need to know if your client is new to Canada. Depending on the country they're coming from, they may be coming from a country with a lot of corruption, war. I had a client from Egypt. We needed a foreign bank reference letter, couldn't get a letter from the Egypt bank. Okay? They often struggle to give full disclosure. Even if that's the case, it doesn't matter from the bank perspective in the sense that the bank needs full disclosure. It is the day and times we live in, okay? Most people are fine with that. Sometimes they are not, okay? Long story short, if they're coming from another country, here less than 5 years, have a permanent job, and have funds for a down payment, and they can afford it, we can look at it at 5% down. We can use hydro bills if we have to. We can use, if they're from the US, it's even easier because we have access to US credit bureaus. Okay, we can make that happen. That's probably your easiest new to Canada program. Okay, once we start to get into shorter job tenure, the bank has a list of risk factors for respective countries. Depending on the country the down payment is coming from, because technically we don't ask a lot of questions if it's been in the bank account. It's either 30 or 90 days. We just changed it. But if it's been in the Canadian bank account for at least 30 to 90 days, I'll double check that for you. We don't ask a lot of questions. But if it's still in Pakistan, they're a high risk level 3, we will not accept the down payment. There's a list. Nigeria. I just did a deal for Dawson. Okay. Client, one of my first questions, where is he from? Is the money here? Great, we can do the deal. Okay, that's just, there's tax treaties involved, there's a lot of stuff involved. Okay. So again, there's different little boxes we fit them into. Okay, that's your, go ahead, yep.
Quick question. Any differences in thinking permanent resident status versus non-resident? They've got their card.
Yep, it's actually very black and white. So if they are not permanent resident, and honestly, I was born here, I don't know the process completely, but if their SIN number starts with a 9, they are non-res, period. If they've been living here for 4 years, residency is not based on where you live, it's based on your tax status. They're non-res, 35% down, period, end of story, full disclosure. Okay? If they are permanent residents, we have options, right? Now we get into the new to Canada program, stuff like that. Can I talk about your deal just as an example? Yeah, so we had a situation where the client had gone to Scotia. Scotia didn't understand the program, went sideways, whatever. We got to the point where we offered, what did we offer? I think we offered, to get the deal done the way he wanted to on the B side, 12.99%, 3.5% lender fee. You have to understand, that risk to a lender is ginormous. And get a deal done, it's gonna cost you. Right? In that case, it was better to wait another month or 2. Right? So yeah, if they're not permanent resident, it's just 35%, period, end of story, unless you want to pay a gazillion dollars in interest.
You know,
Okay, so you're talking about something different, though. I understand what you're asking. So the 15% non-res tax is what you're referring to. Yeah. So Kitchener-Waterloo is in that catch area of the GTA. Okay. So just to digress a little bit, what you're asking, if they are non-res, which by the way, I have no control over, they have to declare that to the lawyer. Okay. Don't lie to the lawyer, please. Only certain things, not that though. Because if you get caught, it's gonna hurt. 15%, just okay. What you're talking about is, and I think you're right, within 2 years, if they become permanent resident, they can apply to get the money back. Okay? I say apply because they have to answer questions. Okay? And there's no way around it. London is not in the catch area.
We technically are though, right?
Kitchener-Waterloo is, yes. There's a map. You Google it, non-res tax thing for Ontario. It comes up on Google Images. So, what else? Investor. So I get a lot of phone calls. Hey, my client's from Singapore. I like using that country as an example because they are on our blacklist. We will not touch money from Singapore. I don't know if it's from that Canadian incident 30 years ago, but we ain't taking money from Singapore. So, investor. So, under new to Canada, sorry, let me rephrase that. Under non-resident program, we will do one investment property. That's all. Okay? Thank you, Vancouver. Okay? So we will do one for them. That's it. Okay? Just want to throw that out there. Any questions on the new to Canada program?
Can we, for a lead generation tool, can we, or do you have like either a one-pager or a slide that we could actually post to different areas to kind of share just the
No.
basics of the program?
No, and I'll tell you exactly why. Remember how I said there's a lot of boxes?
Yeah, too much detail to try and.
It's on our cheat sheets that we use internally for each. I think there's 4 different programs. I call them boxes, 4 programs. Each cheat sheet is 3 pages long.
Okay.
Yeah. Okay. Before I go to that, there's one slide that's not on here that I knew I'd talk about. So, and this is where Sam comes in. High net worth. We used to have a program called High Net Worth, and because of the day and age we live in, it's no longer called High Net Worth. It's called Wealth Accumulator, and let me explain why that is. With our high net worth and our friends at CIBC, where they got caught with problems, was people were showing up, throwing money in a bank account, 90 days later saying, I would like to buy 6 properties, please. I used to work in fraud for Bank of Montreal. Okay? We are the money laundering capital of the world.
Really?
In Canada, yes. Okay? So, having said that, we now call it the Wealth Accumulator. In other words, how did you generate your wealth? Where did it come from? How did you get it? How long has it been here? We would like to know if we're going to approve you for a mortgage, not based on your affordability, but based on the wealth you have accumulated, we would like to know where it has come from. So I have to answer a lot of questions. Okay? I've had everything, and most things are acceptable. Okay? I've had everything from inheritance, cool, whatever, that happens. Okay? Sold a business, sold a house. All that is acceptable. I was given money from my dad can sometimes not be acceptable because you haven't actually accumulated that wealth. You have taken someone else's wealth, and now we're lending to you on money you haven't, someone else has given it. It's like gifted down payment, but not. Not saying no, but that would be a tougher one to get approved under this program. Because what happens with this program, we don't care about the TDS. As long as we have a 1-to-1 ratio, it's not even 1-to-2 anymore, it's 1-to-1. You got 250 grand in your bank account after deposit, down payment, and lawyer's fees. You want a $250,000 mortgage? We're good. We'll give you a mortgage at 35% down. Okay? Now,
What kind of a paper trail do you need on the front?
that's the wealth accumulator part, right? So if they say, I got an inheritance 6 months ago, we may ask for the will. It's full disclosure. You want, and listen, people are like, oh, I don't want, it's privacy. Well, no. You want hundreds of thousands of dollars from us. We don't even know if you can afford it. We're asking a lot of questions. right? And so I put it a little bit nicer to people like that, but that is what it is, an equity program. More questions, okay? Where we can help these clients as well is where Sam comes in. If we have wealth accumulation, they generally have higher advice needs. I just do mortgages. I don't care what their money is invested in. Okay, they could be with Primerica and being hammered on management fees, yet they're worried about a 0.01% rate increase with me. Kind of weird, okay? That's where we bring Sam in, okay? So we'll bring Sam in to have a look at these investments, okay? See if they can save them some money. So what are some of the things you see when you have, not necessarily a wealth accumulator client, but what do you see when you see people's investment statements and stuff like that?
So I'll touch on them in two ways. So the first thing is with their investment portfolio, to your point, there's a weird sense that everybody rate shops on mortgages, but then they become very, very kind of laissez-faire with their fees on their individual portfolios. Now, when it comes to the wealth accumulator plan, the beautiful thing is you might have a client who, you know, when you stop working, you can no longer qualify for a mortgage, right? I'm sure you guys come across this all the time. So the beautiful thing of being able to have either your personal investments, whether it's your RSPs and your TFSAs, or if it's coming from, let's say, the sale of your current property, is if you go and buy a property free and clear, then you have no ability to lend or borrow if there's ever a need. So the powerful thing about the wealth accumulator plan is that you essentially, I don't want to use the word insure, but you protect yourself down the road from cash flow issues. Because you can then draw down that line of credit. So sometimes we'll set clients up with a home equity line with no balance on it intentionally, knowing that somewhere through your retirement, whether it's a health concern, whether it's you want to buy another property, or you want to help a family member, or you want to reverse mortgage, which I'm not suggesting, but theoretically if you want to, it gives you that flexibility, which you're not going to get by taking all your money and putting it down on a house, right? So it's another tool that gives us that flexibility to say you get cash flow, you get protection, but you still get the mortgage piece as well, as opposed to just saying, hey, I'm going to go pay it all free and clear, and then you can't go backwards, right? You can always go forward. You can always take the money out of the investments later to pay things down, but you can't say, hold on, now I have a house, can I borrow 80% of my home equity, or 65 in this case, because in the wealth accumulator plan, right? So usually when this type of conversation comes up, there's more to it. Now, the average person can't use this program, right? Another scenario that I wanted to kind of touch on is, let's say you have a secondary property. So we all know you pay tax on the secondary property, right? Business owners and regular people have a tendency sometimes to kind of go, I don't really want the RSP, I don't believe in RSP, which is fine. I'm not here to change your mind. All I'm trying to say is that if you sell your secondary property, you pay tax. So you can offset the tax on that secondary property with an RSP contribution in the calendar year where you sell that secondary property. So it becomes a really effective way to use an RSP, even though you may not have any, you may not believe in it. That's fine. All we want to do is bring your income down to what I call equilibrium, right? Like our goal as planners is to try and create equilibrium. You don't want spikes in your income because you're just paying more as a percentage. So that's kind of where this tool comes into play.
Yeah. Say it again. If you have clients getting into some of these specialty programs, we try to engage different specialties within the bank because there's usually a lot more to it than just throwing the mortgage together. Okay, and you can tell your clients that, look, RBC is they're gonna look at everything, we're gonna review everything to make sure you're planned properly, you're saving the right money, you're making the right money, all that other stuff. I love when I sit with people and I'm like, how much you paying at TD for a month on your account? They're like $15. I'm like, all right, we'll open up a Visa and you don't have to, and then you're free with us. They're like, what? I'm like, yeah. All right, so we do a lot of cool things like that with them too.